Hello everyone, my name is Amit and I am here to discuss about the hottest topic in UAE corporate tax right now, that is taxation of free zone persons. There were two new cabinet decisions 55 and 139 of 2023 which were released by the Ministry of Finance in the first week of June. These cabinet decisions provide us abundant clarity as to how free zone persons are taxed, and let's understand how they are taxed from a very basic level. Now, a free zone person is any person who's established or incorporated in the UAE. So just because they are incorporated and established in a free zone does not give them a beneficial rate of tax. To get a beneficial rate of tax, they have to satisfy certain conditions and become a qualifying free zone person. A free zone person would be taxed at the normal rate of tax, which is 0% on income up to 375,000 and 9% on taxable income above 375,000. Qualifying free zone person, however, gets taxed at 0% nil rate on their qualifying income and 9% on their non-qualifying income. Now, the million dollar question here is what are the conditions which makes a free zone person a qualifying free zone person? Now, there are five conditions which is prescribed in the law. A free zone person should satisfy all these five conditions to get the beneficial rate of tax. And of course, this benefit is only till the remainder of tax incentive period, which is prescribed in the applicable free zone. The first condition with respect to becoming a qualifying free zone person is having an adequate substance. What it means is that the free zone person should conduct its core income generating activities here in the free zone UAE, invest in adequate assets with regard to their income and activities, employ adequate amount of qualified employees, and also incur adequate amount of operating expenses. So basically what is being tried is that they should not be a conduit company or a shell company which just books income in the UAE because of its beneficial rate of tax but does all the activities elsewhere. No, rather they should be a person who should be doing all the activities here and booking both income and expenses here. So that's about adequate substance. Let's understand what is qualifying income. To be satisfying the conditions for qualifying income, the free zone person out of their total revenue should earn qualifying income much more than their non-qualifying income. Now, what is qualifying income and non-qualifying income? Let's understand. Qualifying income is based or calculated or understood in respect to the transactions that the free zone person undertakes. Now, if the free zone person undertakes a transaction with another free zone person, the income derived from such transaction is regarded as a qualifying income, provided they are not from a list of excluded activities. If the free zone person transacts with the non-free zone person, then the income would be a qualifying income provided they are from a set of qualifying activities. Also, other transactions which are non-qualifying income should satisfy a de minimi requirement. Now, what are qualifying activities and excluded activities? Qualifying activities are a set of 13 activities which includes manufacturing, processing, holding of shares or securities, ownership, management, and operation of ships, reinsurance services, fund management services, wealth and investment management services, services to related parties, including headquarter services, treasury and financing services, financing and leasing of aircraft, distribution of goods and materials, logistic services, and any activity ancillary to the above. Now, here the most important part is point number 11, which is on distribution. Since most of the parties involved in the free zone are in distribution, you should understand that the distribution activity would be a qualifying activity only if the distribution is made from a designated zone to a customer who's not the end user of the product. It should be a B2B transaction from a designated zone and not a B2C transaction. Also, there are a list of excluded activities, the predominant one being transaction with natural persons. Banking activities are excluded activities. insurance activities, financing and leasing activities, ownership and exploitation of immovable property. That's mean to say that if we earn any rental income or capital appreciation on sale from a immovable property which is located in a free zone but given to any other person, or not located in a free zone, those kind of immobile property incomes would not, or activity would be under the excluded activity list. Also, the ownership and exploitation of intellectual property assets and any activity ancillary to work. Now, these lists may seem a little exhaustive, but as finance professionals, what we need to take away here is that if I do qualifying activities from a free zone to a person outside the free zone, still income from such activities would be regarded as a qualifying. However, from a free zone, I do all these excluded activities in the right, even to a person in the free zone or outside free zone, that would be considered as a non-qualifying income. That being said, let's understand the de minimi requirements. Now, what exactly does de minimi requirement means is that again the total proportion of qualifying revenue to non-qualifying revenue should be under a specific threshold. So what it means is that the total non-qualifying revenue to total revenue should not exceed 5%. So a free zone person, to be qualified as a qualifying free zone person, should always have at least 95% of its total revenue coming from qualifying activities, or those activities which are not excluded activities with a free zone person, and 5% of the total revenue, or 5 million dirhams, whichever is lower. However, there are certain machinery provisions attached to it. That is, while calculating the de minimi threshold of 5%, the two items will not be included in both numerator and denominator. That is, it will not be under non-qualifying revenue and total revenue. These are revenue from immobile property in a free zone and revenue attributable to domestic permanent establishment or a foreign permanent establishment of a qualifying free zone. These are just machinery provisions which shows us the calculation. But what is to be understood here is that if my non-qualifying revenue exceeds 5% of my total revenue of 5 million, I will not be, even though I earn qualifying income, I would not be regarded as a qualifying free zone. Now, the other conditions respect to that is that the free zone person should not elect for the common regime, which is the 9% tax on top of income above 375,000. For all the transactions with the related parties and connected persons should be in arm's length, and also there should be proper transfer pricing documentation if the revenue threshold is more than what is specified for a TP documentation. There are also other conditions prescribed by the minister. Now, other conditions are that non-qualifying revenue should not exceed the de minimi requirement, and also audited financial statements are prepared if there is a they satisfy the conditions for preparing audited financial statements as per the corporate tax. Now, if they fail to meet any of these five conditions, a free zone person will not become a qualifying free zone. However, if a free zone person becomes qualifying free zone in year one, but subsequently does not satisfy these conditions, then their qualifying free zone status would be revoked from the beginning of the year in which the conditions are not fulfilled, and the suspension would stay for another 4 years. So, total of 5-year suspension from being a qualifying free zone. So very, very dire consequences if these conditions are not met. Of course, lot has been said, and let's understand how it will pan out in a real life scenario. To do this, we have taken the hypothetical case of XYZ Insurance FZZO, a free zone company which is incorporated in the free zone. XYZ earned a revenue of 250 million during the year, and a profit of 80 million was generated from it. XYZ maintains adequate substance, does all the transactions with the related parties in arm's length, maintains transfer pricing documentation, audits its financial statement and has not elected for the 9% regime. So that makes it clear that to understand the taxability of XYZ, the only condition which is remaining is whether they are earning qualifying income or not. To understand whether they are earning qualifying income, the total revenue of 250 million has to be split into specific transaction, concentrating on where and from whom it is earned from, and corresponding revenue and profit are split up. Now, from each of these revenue source, we should understand whether they are an excluded activity, a qualifying activity, or an allowable activity. So that classification goes by like this. Reinsurance premium from free zone person. Now, reinsurance activities are a qualifying activity. So they would be allowed as a qualifying income, and hence they will not be taken for calculating non-qualifying revenue. Reinsurance premium for mainland companies. Again, reinsurance is a qualifying activity. Even if that is done with a mainland company, it is a qualifying income, and that would not be taken for calculation of non-qualifying income, the D revenue. Insurance premium from free zone companies. Now, even though the services provided to free zones, they are excluded activity, so they would not form a qualifying income. Insurance premium from mainland companies. Of course, insurance premium again is an excluded activity. Same treatment would apply. Investment income from free zone company securities. Now, investment income, since it is coming from a free zone and investment income is not an excluded activity, it is classified as a qualifying activity, and hence there is no uh, non-qualifying revenue associated with it. Income from its domestic parent establishment is not a qualifying activity, but however, the revenue will not be taken for the calculation of the non-qualifying revenue. And rental from a portion of commercial property of which is situated in the free zone from a non-free zone person. Of course, this is an excluded activity, but however, again, revenue calculation threshold will not be affected by this as set in the machinery provisions, because the property is in a free zone. So the total non-qualifying revenue that XYZ earns is 4 million out of 250 million. So taking the de minimi threshold, 5% of 219 million is 10.95 million, or 5 million, whichever is lower. We see that 4 million is way lower than 5 million, and hence they satisfy the de minimi conditions. The non-qualifying income does not go beyond the total revenue by the threshold which is specified in the law. Now, how they would be taxed? Again, on qualifying income, they would be taxed at 0%, and on non-qualifying income, they'll be taxed at 9%. So all the qualifying income will not be taken for calculation. Only the non-qualifying income, which is insurance premium from free zone persons, uh, from its domestic parent, permanent establishment, or a portion of commercial property. All this non-qualifying income totals to 17 million, and the tax which will be paid by XYZ would be 1.53 million, which is 9% of 17 million. And the effective tax rate at which they will be subjected is 1.91 percentage. However, if their de minimi revenue or their non-qualifying revenue exceeds 5 million, let's say, then they would have to pay a tax on 9% of 79.625 million. It's nothing but 80 minus the 375,000 threshold, and their tax bill will shot up to 7.166 million at an effective tax rate of 3.96 8.96 percentage. Now, taking, because they are a qualifying free zone, they are paying almost 5.6 million lower taxes, and that is why this requirement has to be taken very seriously. But however, even if you are a qualifying free zone, one thing to note is that you would have to streamline your bookkeeping so that you know where your transactions are from, and also can bifurcate your revenue and profit to that level. uh, Immediate check that all free zone person should do is whether their current ERP is commensurating with the level of reporting that is warranted by the corporate tax law. That is all with respect to taxation of free zones. I hope you found this video informative. For anything and everything, please look around. As finance professionals, what we should do is wait and watch for more clarifications on corporate tax and deliberate on it. Thank you so much.